All right. We are live. Live in person, live on the socials. All right, we'll get started here. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagren. Hey, Doug.
Merry Chris Kwanzaa and Festivus to the rest of us out there, Kirk.
Festivus for the rest of us is my
That's
favorite
right.
time of year. Get my steel pole and what was the rest of it? I forget the whole thing.
It's just I don't remember it all. I'm terrible at quotes, but all I know is
yell and scream at people.
Air your complaints.
Air your complaints.
Air your grievances.
That's it. Air your grievances. You got the steel pole. There was one more thing, but we'll have to get that. We'll have to get that next week for our next week's session. But yeah, well, happy holidays, everyone. Happy Merry Kwanzaa, whatever Doug said. But
Merry Chris Kwanzaa.
Kwanzaa. Yeah. So it's funny because this year Christmas and Hanukkah are on the same day, which I assumed. I never even assumed that would happen. I always assumed Hanukkah was always the beginning of the month, and I don't remember in my lifetime where that's ever happened. So I don't know. I don't know how rare it is, but somebody was explaining to me it's on different solar cycles, which it's a little beyond my comprehension. I was like, really, this is done on solar cycles? Okay, I'll move on.
Well, to all of our Jewish listeners out there, happy Hanukkah, and you get it over a 2-year spread. So, I mean, many Christians have always been jealous of the extended holiday that the Jewish faith celebrates. This time you get to start it in 2024. It doesn't end till 2025. And of course, you're going to get another one at the end of 2025. So enjoy your multi-year celebration.
Yeah, it's interesting. This year's a little different for us for Christmas. Usually we go out, we have our routine, we go out and get a real tree, go through that whole routine. And this year we didn't, because my son had a mold allergy, and apparently the mold allergy he has, because there's like tons of different types of mold, which is a whole nother conversation. But one of the ones he has is the same one that typically is common within Christmas trees. And oddly enough, our neighbor had the same issue, and she did the same thing. And so they just decorated their real trees outside, so it made it look like Christmas. So it was kind of cool. But so we've got a plastic tree, imitation tree, which kind of sucks. I have to say, I'm a big fan of the real experience and the smell. Even though the smell only lasts 24 hours, it's still pretty cool. But it's still fun. Kids are getting older, and they're getting a little snarky about our keeping with tradition about Santa and our elf Red, who apparently are they think spends the summers in the basement, but or in the Walmart shelf. Which why would you put that there? Anyway. It's all good fun. It's a good time of year, and I think one of the things I really like this year is that a few years ago, I think it was like 4 or 5 years ago, I started this tradition because Christmas and New Year's fell on Wednesday. And if you know anything about corporate employees, well, if it's on Wednesday, why am I bothering to go to work Monday or Tuesday? So some people don't come in before Christmas because you got to do all your shopping. But then after Christmas, well, who's going to really be working on Boxing Day and then on the 27th? So, other people take that time off. So pretty much before and after Christmas no one's working. And then New Year's is the same thing. Well, I want to get ready for New Year's, or I need some extra time. So basically we have 2 weeks where there's almost nobody working. So what I did like 4 or 5 years ago is I just basically took those 2 weeks off, and I spend the time doing reflection. So I do a lot of deep reflection. And so what I do is I kind of pick apart my life and think through like where I am now, where I want to be, what needs to change. And I go through this whole process I call Best Year Ever. And it takes me about 2 weeks, and it is probably my favorite 2 weeks of the year because I just get to spend time just deconstructing my life, tearing it apart, thinking about like all the things I can change and make better. And it's really fulfilling, I have to say. So I'm excited. That starts actually today's the last day, so it starts tomorrow. And so yeah, I really enjoy the end of the year, but there's some other things this time of year too. I know Doug has some really good gifts in terms of GIF, not not gifts under the tree, but I'll share one of them because I just said it. And one of them is oh, I can't see the whole picture, Doug. It says rocking around the tree with plastic. Only sees half the picture.
You can't see it.
Yeah,
Okay,
that's
well,
all I see. But anyway, I'll share this.
you can click on the link at the top, pull that up, but
Okay.
you'll see the whole thing.
Well, we'll see it for now. Actually, let me pull this up just to make it
While you're pulling it up, I'll fill in for you. So the share of respondents saying that they will put up a following type of Christmas tree in 2024 between a real tree and an artificial tree. In honor of you, Kirk, it looks like artificial trees are winning in Germany. It's definitely Germany is the origin, or the Germanic states are the origin of Christmas as we know it. So of course they're still very much into the real tree. 42%. So they're going to do a real tree. 28% a fake. That doesn't add up to 100. So I don't know what the rest of them are doing. Of course, in the United States, hey, we're a consumer-based economy, right? 46% of people are putting up a fake tree versus 26 real. But the United Kingdom has us all beat. 61% of United Kingdom residents or citizens, or however we call it, are putting up a fake tree versus only 20% real trees. So now, granted, I would say of the three of those countries, United Kingdom probably has the least pine trees. So it's probably a little bit more difficult to get an evergreen in the United Kingdom than it is, in the United States, which still has a very concentrated boreal forest access to it, pines everywhere. And of course, I think they probably have the same in Germany, hence why the Christmas tree was, started as a symbol. But, I find that very, so that's not real surprising that the United Kingdom's using plastic trees. But, I got to be honest with you, Kirk, we've got an artificial tree. And right now it's funny. Even after year one, it was nice. It was beautiful when we opened it up. Get it all in there. You've got the fancy, remote control now that'll do any number of colors and any number of like styles and, flashes and all this stuff. And that got boring exceptionally quickly, and annoying exceptionally quickly. But then on top of that, Christmas ended, and then we had to put it somewhere. And fake trees are a pain in the butt. I mean, it's like I got an entire shelf in my garage just dedicated to putting this Christmas tree away that I have to take down, wrap in plastic to bind all of the branches together to get it, somewhat concentrated in space, put it in a red bag, which then of course the mice got into this year and chewed a hole into, put it up on a shelf to bring it back out 350 days later to pull it back down, to put it up for a couple of days. And now year two, 20% of the lights won't light up. Year three, 40% of the lights won't light up. Now we're at I think year 5, and they're lighting up still about 60% of the lights, but now they're only lighting up to about 40% brightness capacity. I mean, these things are not meant to last. Welcome to, the running joke of everything that's built these days. The storing and stuff. So guess what we do? We put it in our basement, but we go out and we buy a natural tree every year. So I've got an artificial tree. I'm still putting up a natural tree.
We call that, Doug, we call those first world problems, or I have leaves in my pool kind of problems.
Yes. Well, fortunately, the good news is that most of the people listening live in the first world, so they at least relate a little bit. And if we had a large following of individuals from third world countries, this might not necessarily be as understandable, but hopefully everybody listening can relate. So.
Yeah, so let's talk about some of the more relevant, timely stuff. So Powell came out, lowered interest rates as people expected he would, and now we're a full percentage lower than where I thought we should be to begin with. So at the moment, where are we? We're at 4.25, 4.5. I think we are. I think that's the range. And frankly, I think we should be 1% higher. But here's some interesting things. So the Fed has obviously come out and they're lowering rates, and they're trying to boost the economy and make everyone feel good. the market took a nosedive this week, much to everybody's chagrin, because everyone's in the festive mood and everything goes up and never goes down. But markets had a big down day because Powell gave us some coal in our stocking. Basically, gave us a little bit of a bearish sort of feeling. And I think what's interesting is, the markets typically, if you talk to an economist, they say, well, all the information's known and the markets are efficient. They have all the information. They're going to price it properly. In my experience, the markets never price it properly. And that's just that's something you do when you're in a vacuum and you're in a classroom where facts don't matter. But the reality is never priced appropriately. We talked about this about a year ago when people thought that interest rates were going to drop, I think, 9 to 12 times. And we accurately said it's probably going to be zero, maybe, once or twice. So we were a little off, but we're certainly closer than the other ones. It was zero up until the election, where they felt like they needed to goose the markets a little bit. In my opinion, they didn't need to do that. But so here's the thing. If you look at the stock market, if you look at the economy, everyone's feeling good. Everyone's feeling great, actually. Nothing to see here. Everyone's fine. But the Fed doesn't feel that way. The Fed's looking at the job market. The job market's starting to look a little bit soft. It's not bad, but things are starting to trend in the wrong way, and the Fed's getting a little skittish. And so if you look at all the different aspects of, I'm going to try to bring some up here. If you look at all these, the different aspects of what, let's see, here it is. Different indicators that people look at. Now, here's one, it's the inverted yield curve. And people have been saying this since it inverted, that, the inverted yield curve, we're going to go into recession tomorrow. I actually didn't have the data to suggest it one way or the other, so I didn't have an opinion, as you all know that have been listening to the show. I said, yeah, but I think what happens is when it reverts back to normal, that's when the recession happens, not when it stays inverted. And that was my hypothesis, and I think it's proven to be true because it's been inverted for over about a year and a half now, and we haven't had a recession. But now that it's going back to normal, now we're starting to see an indication of a recession. So
it just reverted a couple of weeks ago, like a week or two.
Yeah, it was it's kind of like tweaking around the line, so it's right around even, but it's you could make the call either way. Either way, it's hitting break even, and then depending on the day, it could be a little here, a little there, but it hasn't substantially broken it to normal. So it's hard to say, but I think it'll be really interesting. And my thesis still holds that when we go back to normal, then the recession will happen. So we're right around there now. And you could, like I said, you could say a little yes, a little no. I'm not sure what's correct because I'm not sure I've seen it happen before one way or the other. But my thesis still holds that I think once it goes back to normal in a resounding way, that's when the recession's not far from where we are. I won't get into the details here, but the SAM rule people talk about as a recession indicator. That's another one, which once it goes above 50 basis points, it indicates a recession. If you look at confidence indicator, I'm just bringing up a few charts here just to kind of share with everyone. There's a lot more, but here's some. This hasn't come to pass yet. This actually you could mark as saying, well, maybe not. Because it hasn't flagged it yet, and it's been there for a long time. So basically, a confidence board leading economic index, it talks about basically the growth rate. So once it's negative, it's a recession signal. A negative growth rate for the 6 month. So there's a lot of different indicators, but then there's other ones too, which people aren't really looking at, and I don't have them in front of me, so I'll have to pull them up later. But basically, you can look at things like the high yield bond market. That's another one that I think people should consider. So if you look at high yield bonds, you can see what the yield is. And if the yield's low, it means that people aren't really worried about recessions. When the yields pick up, people get a little squirrely, right? Because they're worried that, hey, I've got this really risky bond that when times are normal, I'm feeling good. But when times are bad, oh my God, this company could go bankrupt. I know it's a pile of crap, but I bought it because it's a good yield. And it kind of brings me to an example of what happened a few years ago with Puerto Rico. Now, in the municipal bond market, Puerto Rican bonds have always been a higher yield than everything else. And I've always considered as like a moral obligation for the government to basically bail them out so that they were okay. But it was a higher risk endeavor. And so what ended up happening was they defaulted on the bonds and everyone lost a ton of money who was invested in them. But a lot of these high yield bond portfolios, and I'm just making these numbers up for example, but let's say the municipal bonds were paying 3.5%. Usually it's between 3 and 4 for like the last 20 years, but let's say 3.5%. And the Puerto Rican bonds were like 4.5%. Well, a lot of fund managers, what they do is they dump a bunch of Puerto Rican bonds in their portfolio because, hey, I can get 4.5%. I'm looking pretty good until something bad happened. And then, everyone lost a ton of money who was invested in Puerto Rican bonds. So, yeah, I think what you have to realize, and this is, and I'll segue into what I mean by this. So, all of these indicators you have to keep an eye on. Everyone's super bullish right now. They're bullish because the economy's good. They're bullish because earnings are generally pretty good. I mean, I wouldn't say across the plane, but generally they're pretty good. We have a new president coming in with pretty much a mandate to do whatever he wants. We had a clear decision in the voting polls. Like him or not, doesn't matter. The country voted and the country agreed. Same thing happened with Obama. So for those of you who are liberals, same thing happened with Obama. He had a clear mandate to do whatever he wanted. Now Trump has a clear mandate to do whatever he wants because the country voted. That's what they want. They want something different. They want to change. So we have that, and that people are perceiving as bullish because Trump is perceptively a pro-business president. We'll see. There's some things in there that I'm still kind of let's just say I'm not decided yet. If you have things like tariffs. Now I know he's using tariffs as a way to basically negotiate with people as a starting point, so I get that. However, there's also this theory with him and his team that tariffs are better than income tax. Now, I could say that virtually every single person in this country would love tariffs over income tax. Just imagine you're getting an extra 20 to 30 or even 40% of your money back every year that you don't have to pay the government, and it comes out of tariffs. Well, that tends to be inflationary, and it tends to lead to being taxed in another way. But theoretically, that's what they're talking about. I don't know if they really mean it. And I'm just going to be really clear. I don't know if they actually mean it, if they're just saying it. I think if they actually went forward with that, it would be pretty disruptive, and I'm not sure I'm fully supportive of it. I'm open-minded. So I'm willing to listen to the argument of why it makes sense. They've talked about 100 years ago, we were all tariffs before the income tax. And I'd say, well, that's great, but all countries were. But now all countries use income tax. Some use VAT tax. So is that going to actually work? I don't know. That's the point. I need somebody to talk me through it and explain logically why this is going to work. And I haven't heard that argument yet. So to be determined, we'll leave it open. I have an open mind to it, but I have my reservations as well. But if you think about where everybody is, everyone's super bullish up until the Fed said that. And now everyone's like, oh my God, the market dropped 3%. What's going to happen? Is the world going to end? It could be because you got drones over your head, or CEOs are getting assassinated, or they're rattling sabers or whatever. There's stuff going on every single day that's scaring the pants out of people. I would suggest that as we go into the new year, we are at one of the most expensive markets that we've ever had. Everyone's super bullish. Nobody's bearish. That's actually a bad sign. Because if you think about how markets operate, when everyone's on one side of the boat either tips over or it goes the other way. Because then it's going to tip over. What does everybody do? They run to the other side of the boat. Run to the other side, it tips the other way. Then they run back and run. So that's how markets work, right? Is effectively people are going all in or all out. So what I suspect is going to happen is everyone's bullish. Something is going to happen to change that. I don't know if what Powell said is going to change that. If not, we're going to keep going until something breaks. At that point, people are going to freak out. They're going to start to sell, take profits off the table, and we're probably going to drop like 20%. Now, does that mean that we're in a recession? Does that mean that the stock market's going to crash and go to zero? No, none of those things. But we are way overpriced, way overvalued. We had an average year economically, and yet we have a way above average performance on the stock market. I just don't think that's sustainable. So I'm being realistic. I'm bullish. Just to be clear, I'm bullish on where things are going. I think we're at the moment, things are looking rosy. However, I do think that we should be probably 10% lower than we are, and that would be a comfortable place for a bull market. So we're at least 10% ahead. Now, I subscribe to this theory of reversion to the mean. So if you look at the mean, let's say the market goes up 10% a year as a hypothetical, right? Market goes up 10% a year. And if you look at some charts, you'll notice this where you have this line that goes up. Oh, the markets go up 10% a year or whatever it is. Sometimes it goes up 30% and it's way above this line. Sometimes it's down like 20% and it's way below the line. So what tends to happen is the reversion of the mean means the mean is where the market should be, but it rarely, if ever, is. So what happens is it's above the mean or it's below the mean. Well, think of it like a rubber band. If it goes too far in one direction, it snaps back, but it doesn't snap back to the mean. It snaps back below the mean, right? Because it's basically reversion to the mean. So the way it works is it goes from one extreme to the other extreme and eventually goes back to where it should be, right? And it's kind of like a beach ball. You hold it underwater, the further down, the further up it goes, and eventually it settles on the equilibrium on the surface. The markets operate the same way. So I think if we drop 10%, that'd be comfortable. We'd be in good shape. People won't like it because, oh my God, the world's going to end. But that's just because we've gotten comfortable because we've gotten used to the fact the markets just go up straight and there's no bad things can happen. So I think it's gotten ahead of itself. I would like to see it a little bit lower so we can continue on this pace. I know you're all going to like stone me to death because I said the market should go lower, but if you want a sustainable upward move, that's the healthiest way. If this continues at this pace, we're going to have a really bad, I don't want to call it a crash, but it's going to get worse. So if it goes up another 10, 20% really quickly, it just means it's going to go down harder. So, people who are smart, who are thinking about this the right way, do your year-end tax loss selling, take some profits off the table, think about it from a bigger picture perspective. Just because you had a good year, it doesn't mean it's going to keep going. Just, take some cash off so you can buy in on a dip. It doesn't mean you take it all off. Maybe take 10, 20% off, whatever you're comfortable with, and keep it on the sidelines, wait for that dip, and then you buy back in when you're comfortable. So just something to think about this time of year. Don't get caught up in the bullish sentiment just because it's Christmas and Hanukkah and Kwanzaa and whatever you celebrate. It makes everybody feel good. That's why the Santa Claus rally exists, although it's not happening this year, apparently. So just that, keep in mind. Doug, what's on your mind today?
Well, actually, I want to kind of add to what you just said regarding the reversion of the mean aspect of it. And of course, reversion of the mean also leads to something called sequence of returns, which is ultimately what is the impact or the average of returns that you're getting. And what does that mean in terms of the timing you're getting those returns? I think it's really important. As many people listening are at different ages, different stages in their life. Over the next 5 to 10 years, you're going to have an accelerated number of baby boomers and starting to see more Gen X that may turn into looking at retirement. And the timing on when you do that really is going to matter, and the timing of whatever that reversion the mean might be is going to have possibly a major effect on your ability to have that hit those goals that you were looking for. We all can look back and know at least a story or more of individuals in 2008 or 2000, even like 2013, 2018, when we've had some of these pullbacks, 2020, that had to make different plans based on the timing of whatever occurred in the markets. And there's 6 major risks and that happen to impact people's ability to have financial freedom and independence and financial peace. And one of those is obviously market volatility. So, nobody knows when this is going to occur. I mean, we've had a a market that has been continuing to rise up at extravagant amounts over the last 10 to 15 years, you could that's a reversion to the mean that occurred in again, if you look at the secular cycle, which is the long term, that's a reversion to the mean of the snapback of what happened after 2008. And of course, with QE and the injection of capital that has happened since then on a sustained basis for the most part, you're getting the results of assets being highly elevated. But you made a point there of how that reversion, needing that reversion to occur in order to go higher. Actually, and I just posted this last thing up there, Kirk, if you want to pull, we're actually starting to see more and more cash to the sides. The U.S. money market fund assets rose to $7.2 trillion. And they had been pretty consistently at around $3 billion, $3 trillion of, from 2011 to around just before 2019. It really hadn't grown much at all since the end, since 28. I'm looking at it. Maybe it was right before 2018. It's kind of in that time frame. It has been a rapid increase. Some of that, spike up happened in the 2020 pandemic, but it was starting before that. While we had a little bit of a snapback after the 2020 pandemic, leading into the latter part of 2020 into 2021, and we held at about 5 trillion at that point. So we'd gone up from 3 to over 5, and then settled back into 5. Since we've gotten into 2022, 23-ish, it has been a spike now up another $2 trillion of money market, and it's concentrated in a handful of major managers. Fidelity has the largest single amount at $1.4 trillion in money market. You have JP Morgan and Vanguard and BlackRock fairly close, although JP is about 746 billion, Vanguard 667 billion, BlackRock at 600 billion. Then you start getting into Schwab, Federated Hermes, Goldman Sachs, all kind of in the 5s and 4s. The rest of managers combined have about $2.2 trillion in money market, which is, less than Fidelity and JP Morgan, or Fidelity and Vanguard have combined. So what does that mean? Well, you mentioned that reversion to the mean, and we have to have that snapback. What's happening is, as well as the markets are doing right now, as much as those valuations have continued to go up, it's actually doing it inversely correlated to the amount of money that's being injected into those holdings. So there's a lot of money sitting on the side. I mean, there's been talk about Warren Buffett having, the most money he's ever had, arguably, sitting in cash, as he's been looking for opportunities. He's basically said it's too expensive to make moves out there. And so if you're happy with what has occurred in your portfolios, given given the lack of the amount of liquidity that's sitting on the side, imagine what happens if we can get a pullback that now gets the money managers, people like Warren Buffett, to find that there's finally going to be a reasonable reason to inject that capital back into the markets. Because right now, we talk about supply and demand all the time. What you're finding is that what's really occurring in the markets, and it's been happening for quite a long time, is really a supply issue, right? We've talked about this before. A lot of what's driven the markets higher has been stock buybacks, reduction of supply of companies' own stock. As they made profits, they're buying back their stock, less shares. All of a sudden, that's going to drive share prices higher. But what's now happening is there's all this extra money, this new money that's out there, has not been injected, is kind of growing and growing. It's not being injected back to purchase those shares. So we've had stock prices go up based on liquidity of companies, in many cases, buying their own stocks, reducing the supply, lower supply against equal demand. That's going to create a higher stock value price. Imagine what happens when we now have taken this lower supply of shares and get to the point in which those that are sitting on the side with money markets, for whatever reason, maybe it's just because, look, the safe rate of return right now in treasuries and money markets is just worth collecting, that 5-6% and not necessarily having the risk of the markets. But imagine when it gets to a point where now not only a reduced supply, you increase the spike of demand. Okay, that's exactly what happens in all the other inflationary areas of our world right now, right? We have reduced supply, but we had all this flush capital, increasing, demand significantly to buy a reduced number of goods. Kirk and I have talked about this before. It doesn't matter if you inject money into the system. If that system can produce enough goods to absorb the money, you don't get inflation. We had that for 20 years. Now we have less goods, more money supply. That led to an increased amount of inflation for the goods that remain. That's the same aspect that could happen to the equities markets if all of a sudden you have reduced supply of equities and a massive supply of liquidity on the side that now wants to come into play and you spike demand. Imagine what that could do to the markets. The only way that's going to occur is for us to have some sort of a reversion to the mean that now creates a feeling that there's value back in the market that is worth applying that liquidity. Kirk, you're on mute.
Oh, sorry, Doug. I was talking to myself again. It's not the first time. So it's great, Doug. So I think, the takeaways here are we're wrapping up the year. We'll have one more podcast next week for the end of the year. But, it's a good time of year to reflect on what's important. It's a good idea to reflect in your portfolio and try to remove the emotion from it. Try not to look at it. I know cryptocurrencies have done great this year. Gold has done great. The Mag 7 have done great. Everything's done great this year. Very, very few things haven't done well this year. And I think the thing to keep in mind is this, is that when you're having a good year, stop to think about, if you remove your good feeling about it, how would you react? Should you reallocate your portfolio? Should you take profits off the table? Is it maybe a good idea to sell some of your positions? And then you got to consider taxes, right? Because you got taxes too. Like there's some positions that I want to exchange. Like for example, there's some cryptocurrency ETFs out there. Some have a lower expense ratio. Some have a high one, right? Or other ETFs, right? Or stock ETFs. You can say, well, this one's lower than this one. And you look for opportunities to save money on expenses, right? So as you go through that, you have to think about, well, this is a good time to do that. But why not just wait another 12 days, 13 days, because markets aren't open on the 1st. So 13 days, and then you can sell then. And now you've pushed your tax burden onto next year. You're 13 days away from doing that. So sometimes it makes sense to just wait and push it. Other times it might make sense not to, right? So if I look at, was it like 2-3 years ago? I think it was 2022, the bad year, when everything was down. The end of the year, people were doing tax loss selling. They were pushing the price down of a lot of different positions. Well, that was a great time to buy because everyone's selling. So go in there and buy, right? And if January 2nd, 3rd, and 4th, the markets don't rebound and they keep going lower, okay, well, you can always get out. But if you look for opportunities like that, and unfortunately, there aren't many positions that people are doing tax loss selling for because the markets overall are up. But if you have one of those positions, it's a really good opportunity to take the profits off the table, and you can always jump back in later, right? You can always come back in at a different time. You can wait, you can buy in, but or you could try to find a stock that you've been waiting to buy, and now when people are selling it in droves, maybe now's the time to pick up some shares because you're going to get a good deal. You can always sell it a week later, like once the markets start next year. But I talk about this in the show occasionally. What you'll find is there are certain times a year where there are some noticeable pivots in the market. One of those times a year is December 31st and January 1st. And that pivot is basically tax loss selling, people trying to position their portfolios at the end of the year. Lots of reasons it happens. That's a big pivot point. So if there's going to be a change in direction, it will frequently happen then because people are finished their selling and now they start buying. On the other hand, one of the other, well, one of the other ones is the end of Q3. So you basically got end of September, early October. And the reason that's important is because a lot of hedge funds put out their annual reports, or other funds put out their, their annual year. Their wrap up is usually at the end of that quarter. So what tends to happen is you have that, plus you have the fact that it's the end of a quarter, plus you have the fact that that's one of the softer times of year. September, October, early November are kind of the softer parts of the year historically. So you have all that going on. So sometimes you'll see a pivot around then too. It can also happen in Q1 and Q2, but generally speaking, the end of the year is the biggest one in my mind. Sometimes there's some others, general markets in February, if there's a great January. So this is another thesis we're running with too, is that, we have a great January, things keep running, and then February things kind of fall off the cliff in a short blip and freak everybody out, and then it comes back. That's not uncommon. Okay. And I don't know why February, but it happens, and people freak out for like a week or two, and then things are back to normal. So just something to keep in mind. Those are some points historically that I've seen tend to be a little bit more sensitive to sell-offs. So because of that, we're just being really cognizant of the fact that we have started to see some sell-off with Powell's speech, but we also have the Santa Claus rally coming up. So I think that's going to buoy the end of the year. So we'll see what happens. But just be mindful of these pivot points. Not to say that you have to freak out and sell everything, but you should be paying attention. And if you're looking to buy or looking to sell, pay attention to these points, because it might give you some guidance as to whether you should do it or not. All right. So one thing I did want to hit on, because I found this chart I was looking for a long time, and now I found it. Here's the high yield bond spread. This is basically the spread between high yield bonds and more or less a risk. I think it's risk-free rate. I'm not sure which one they use here, but basically it's the spread over the risk-free rate. So it's how much are you getting paid for the risk you're taking. That's the definition. So if you look back at 2009, everyone thought the world was going to end. They're paying, 20% for high yield bonds over the risk-free rate, which is effectively zero at the time. So you're getting 20% of your bonds. Well, that's great. I'll take that risk for, a reasonable credit. Now it's like, it's almost 2%. It's like 2.5%. It looks like over the risk-free rate. Well, I'm not sure it's worth the risk. Now, will people do it? Absolutely, they are. Everyone's doing it. That's part of the problem, right? Is everyone's doing that. But if you look at the history, and I'll be mindful, this is a potential chart crime. It only goes back to 2007. But, if you look at that period, 2007 to today, that's what, a 15-year period or somewhere thereabouts. There was a lot of volatility in that 15 years. So I think there's enough evidence there to say, okay, within recency, that is one of the lowest periods. You should be mindful of this. This means that people are undervaluing the potential risk. I would never buy a high yield bond with that kind of a spread. It's not worth the risk. I'd rather just go out and buy a U.S. Treasury, like a 3-month or a bill or whatever I can get me 4.25%. And I don't care if it's going to get me 6.25%. I'd rather not take the risk. I'll wait until the markets bounce because people are freaking out, and then I'll do it. Right? Why rush it? And so this is one of my pet peeves with the fund management industry and the wealth management industry as well, is that people are asset allocators and they're not mindful of market conditions. So their thesis is that we should always have large, mid, and small cap, international, emerging markets, bonds, high yield bonds, emerging market bonds, cash, gold, all these things. Their thesis is we should have all these things because a diversified portfolio reduces risk. Now, if you listen to the show, you know that most of that is bullshit. It's not 100% bullshit. It's what we call a half-truth. A half-truth is something that's true most of the time, but not all the time. And that time that it's not true, that's where it gets you into trouble. So the diversification theory came out as an academic paper, and Wall Street took it as a way to sell more mutual funds. That's why we talk about this at all. It is not a way to manage risk. It's a way to manage volatility. There's a very big difference between risk and volatility. And so if you're managing a portfolio just diversifying because someone told you it was a good idea, you're missing it. There was a time 50, 40 years ago where diversification actually worked well and it helped reduce the volatility. The problem is now everything's really closely correlated. So it doesn't matter what you're in, it's going all up and down all the same. We saw that in 22, where even bonds were going up and down the same as stocks. So you have to be mindful of just taking a half truth and assuming it's true, because that's where you start to lose a lot of money. So what I would suggest for all of you is be mindful of each of the categories that you're considering. I'm not saying they're a bad idea. I'm not saying they don't work. I'm saying that if you're looking at high yield bonds because someone told you it needs to be in there, maybe you should reduce that quite a bit and maybe not have high yield bonds. Maybe you should look at other categories as well. But real quick, and I'll head it back to Doug and we can wrap it up here. I do want to touch on the difference between risk and volatility. Risk, as I would define it, is the permanent impairment of capital. An example would be you buy a company, it goes to zero. You buy Enron, it goes to zero. That's permanent impairment of capital. You're not getting that money back. Here's another version of that. Now, it's not completely true, but it's a version of this, which is the stock market. You buy stocks into January of 2000, and then you don't break, and then the markets go up and down, but basically lower for 13 years until July of 2013, where it started to exceed the price of January of 2000. That is 13 years of lost compounding. That is also a permanent impairment of capital, in my opinion. Now, technically not, because you get it back, but who wants to basically put your money under the mattress for 13 years? That's stupid. So that's risk. Risk is basically a peril or a way that you're going to lose money. Volatility is the bouncing around of the stock market. It's up, it's down. It's up, it's down. That's volatility. And volatility is basically the markets operate in a range. It goes up 2%, down 1%, up 3, down 2. It operates within a reasonable range, right? You may not like the range. Maybe it goes down 10, but it's still a normal-ish range that it operates. That is volatility. Volatility picks up and people get scared. Think of volatility like a roller coaster, right? If you have a roller coaster, volatility is the ups and downs and the twists and the turns. Risk is your car flying off the roller coaster track. That's the difference between volatility and risk. So you have to understand that. People freak out at the volatility because they think the world's going to end and they feel like it is. But the reality is it's just volatility. It's not risk. If you're investing in a crappy company, there's risk. If you're investing in the index, the risk is that it goes down for a long period of time and doesn't come back. And right now, I don't see that as a risk, but you always have to be prepared for that. And if you don't have that in your portfolio as a way to manage it, then you need to reassess. Doug, final thoughts and take us home here.
Oh, all right. So I'm just gonna have some fun here. Roll through a couple things, Kirk, that I've got here at the bottom of your list, so it'll be easy for you to find. But let's start with one thing you just said. If you actually, this one's not gonna be quite to the bottom. If you scroll up a little bit above the charts you were just looking at, you'll see one that I posted here because you talked about asset allocation. You talked about just and keeping a diversified portfolio all the time. I like what you said about high yield bonds. And I think one of the misnomers on high yield bonds is calling them bonds, because they are bonds, but people think of them, oh, it's bonds. It must be in the safe part of my portfolio. And again, safe being relative, but historically people have looked at fixed income as the way to temper that volatility. High yield bonds work like equities. And one of the things I've always said to my clients and my mentees is that when I'm coaching on this, is that you should really be looking at high yield bond almost as an aggressive high dividend stock, because as you saw on the chart that Kirk was showing, they tend to have the best possible opportunities for upside after everything has declined in the regular markets, in the equities markets. Why? Because ultimately then the higher yield that they're giving, they also are going to have a lower valuation. It's a good time to buy into that, arguably, because at that point in time, you're getting still paid that high yield, but now nobody wants to touch it. And so equities have all gone down at that moment because people think the economy's poor. Well, that's the same way they're viewing those that pay poorly or have bad credit. They are not viewing them as a good investment, and therefore it's going to be cheaper to buy at that point, just like equities. But that can allow you to have a very high yield against a high upside appreciation potential. The other thing I was going to say again about asset allocation is, here is a chart that we've got, Kirk. I'm looking at the one that actually shows S&P 500 versus Russell Midcap versus the Russell 2000. If you take a look at that, well, yeah, should you be just diversified across the board? Well, 94% of companies in the S&P 500 are promoting positive earnings. There's only, whereas, only 6% of negative earnings. You get to the mid caps, 86% are positive, 14 negative. Not bad, but let's take a look at the Russell 2s. And they are now at the lowest ratio against the S&P 500, I think arguably in history. Well, there's a reason for that. 58% of the Russell 2000, which is small caps, are positive earnings. 42% are losing money. Okay, so is it a good time to be in the Russell 2000? Well, it hasn't been a good time to be in the Russell 2000 because the metrics have not been strong for the Russell 2, and it's continued to decline. Now, we're starting to get to the position where arguably if the fundamentals look right and the conditions change, it might be a better time to allocate in the Russell 2. But if you've just been holding large caps, mid caps, and small caps all this time, just trying to, be diversified, it's not necessarily been working out for you. And I think that's just more justification of what Kirk said. Also, the last chart I just put up there, I think it's kind of interesting, is if we've looked at with S&P 500 top 5 bull markets. We are sitting in where the tech boom of the 90s, at 582% growth during that period, 12.3 years that bull market had lasted. It's still the king. It's still the longest bull market that we've been in. Now, if we take a look at where we are right now, the post-financial crisis, which is, that went, basically that went on for 10.9 years. You could argue this chart only went up to 2020. So they might be arguing that with what happened with COVID, that was the end of it. I don't know necessarily whether or not that, that's where they're cutting it off, because a lot of people could argue we may have had a cyclical bear market there with COVID, but we're still very much in a secular bull market that has continued if you take a look at where we are in relation without really any major recession that's occurred. So, we are, depending on how you look at the metrics there, still behind the tech boom, but very, at this rate in time, we are in the second, if not not soon to be the longest bull market we've seen in history. So again, what happened after tech? We started to see we had a reversion in the mean. What do we expect was likely going to occur eventually because of how great this bull market has been? A reversion in the mean. Lastly, I want to leave with a couple statistics just because we're going into Christmas and I know we're right up on the hour there. But hey, I'm going to, just for fun, men and women, we are not that much different. I don't know if you can find that chart, Kirk, but most desired gifts in the U.S. this Christmas. Share of U.S. respondents happy to receive the following Christmas gifts this year. No surprise that men and women both agree that money would be their favorite gift. Women are certainly arguing that more than men at 45 of the respondents. I don't think this is percentages. 45 of the respondents or said this. I'm not going to, percentage. 45% said they want money first, 34% men. Clothing, textile, and shoes. Both men and women agree. Vouchers and gift cards, effectively cash. Both men and women agree. This is where it changed a little bit. They say the key to a man's heart is through his stomach. Well, number 4, women like cosmetics, perfume, and body care. Men like their food and drinks. I don't disagree with that one. But then right after that, we come right back together to smartphones, tablets, and accessories. And then, of course, because food and drink was swapped there, we get into computers, accessories for men, and then jewelry, watches, and, are there. So, hey, maybe we're not so different after all, because we seem to like mostly the same things. Also, online shopping. I think it's really interesting that looking in 2024, where have we gone in terms of online sales as a percentage of total sales? it's still not all shopping, but we're looking at basically the 1 to 3 quarter average versus the fourth quarter. We definitely see a spike happening there, but we're still looking at online shopping is still not that, it's still under 20% of all the shopping that occurs. So even though it is, we're seeing a surging demand for it. In 2010, it was less than 5%. We're up to 20. Traditional going in and buying things in retail is still winning. And of the, wanted to also, this is from 2023. What's it going to cost you? I don't have the 2024 numbers, but we can certainly deduce. The United States the average was $1,205 in on household festive expenses in 2023. Canada was and Germany were beating us out at $1,700 and $1,600 respectively. But again, just if you're trying to think, I don't know, got variable expenses. Where is this all going? I don't know how to plan for the budget. That gives you a little something. Think about $1,000 to $2,000 on average is what we're spending in the United States for Christmas. So also, Kirk, you talked about the poll. I did put in there there's some information. You can go to festivusweb.com and how to decorate your Festivus pole. And how to make sure that you can put it in. And and the top rules, do not climb the Festivus rule was number one. So if you want to have some humor, go out to festivusweb.com, all about Festivus and some great quote, on all the quotes you were talking about how George couldn't stand Christmas because during that period, his dad always put up a poll. I want to leave you with this. As people know that have listened, I focus a lot on the financial impact of college planning. And, college planning is not just about getting the cost down. It's about how you pay. The impact of college planning, this is from Ramsey Solutions, but how much federal student loan debt is out there by age? It is rapidly spiked for those that are under the age of 50. If you look at 70 plus, it's 30 billion. So 70 plus aged individuals are still holding on to $30 billion over in federal student loan debt. 60 to 69 is 110 billion, 50 to 59 at 240 billion, 350 billion for age 40 to 49. The biggest by far the millennials at 30 to 39, they're facing $520 billion in federal student loan debt. It has dipped back down for the 18 to 29-year-olds at 340. That's because they may not necessarily have all of their graduate loans. But obviously we are talking, add all that up, well over $1 trillion in student loan debt out there. Now, some of that student loan debt can be good debt, could lead to a degree that pays you well. A lot of that debt, unfortunately, is to degrees that don't pay. Now you're facing, how do I deal with that? And the financial impact, I can get into this in another call. The people are facing the uncertainty of having debt. Number one thing that was listed as the biggest financial stressor, and I've said this before, is access to capital and having debt paid off. So clearly, if you go into college and you go into other types of major purchases and you don't have a plan on getting them, that's going to lead to debt, and that can lead to a domino effect of insecurity in a lot of different areas financially. If you want to have security, you have to have a plan. You cannot go into this with the plan being hope. And if you want to start that, you need to start that today. It's December 20th. When we're doing this podcast, for those of you listening live and will listen later, we're coming to the end of the year. Kirk talked about doing planning, reflection, going into the new year. One of those things that you could do is look at putting your financial house in order to try to keep it that way forever. And if you've got kids who are in high school or even earlier, it's great to start. But if you've got kids in high school and you're looking at this upcoming major cost of college, you cannot just ride into this blindly. Get the information now. Go to our website, mergentcollegeadvisors.com, MERGENT, mergentcollegeadvisors.com, and begin the journey to financial freedom. And that starts with making smart decisions with your money today.
Great. Well, thanks for coming on, Doug. Merry Christmas to you. Happy Festivus. And we'll see you next week. And that's the show for this week. Thank you again for joining us, the Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archive shows. Also, check out a YouTube channel. When there, please subscribe and leave a comment. Lastly, please leave a show rating and comment on the podcast app of your choosing. Don't forget, do your own research. This show's for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Happy Festivus to you all. Good luck in your feats of strength. Have a great week ahead. And remember, no one will care about your money like you do. So invest in your life.
And one last thing, the answer to how to decorate your Festivus pole, do not decorate your Festivus pole. Have a great